We're about to talk about something that, let's be honest, most people think is incredibly boring. But what if I told you it's actually the hidden operating system for the entire financial universe?
I mean, what if there was just one single number, hiding in plain sight, that could give you a pretty darn accurate heads up that a recession is on its way?
And what if that same number was like a kind of financial gravity, basically setting the value for every single stock you could possibly own, from Apple to a tiny startup?
Well, that number is very real, and it comes from the bond market. So yeah, forget stocks for just a minute. Because if you really want to understand the secret code of money, you absolutely have to understand bonds. So, what even is a bond? Let's just break it down to the absolute basics. You'll see it's way, way simpler than it sounds. At its heart, a bond is just a loan. That's really it. When you buy a bond, you are literally lending your money to some big organization. Could be the US government, could be a huge company like Apple. You're the bank, and they're the borrower. Simple as that. And in return for lending them your money, you get two things. First, they promise to pay you regular interest. Investors call these coupons. And second, at the very end of the loan's term, which is called maturity, you get your original cash, the principal, right back in your pocket. Okay, now this brings us to a really key idea: yield. The interest payment, that coupon, is fixed. But the yield? That's totally dynamic. You can think of it as the market's live, real-time answer to the question, how much do we demand right now to lend our money? And that number, it is changing all the time.
And this is probably the most important thing to get about bonds: the financial seesaw. When interest rates out there in the market go up, the price of older, existing bonds goes down. Think about it. Why would anyone buy your old bond with its lower interest payment when they can get a brand new one that pays more? They wouldn't. So to sell your old one, you have to drop the price. And of course, the exact opposite is true. It's this fundamental inverse relationship that drives everything.
So, if bond prices are always moving up and down on that seesaw, what's actually pushing them? Well, it really just boils down to two big risks.
The first one sounds a little technical. It's called duration. But all it is a fancy word for interest rate risk. Think of it like a lever. The longer the lever, the higher the duration, the more a tiny little nudge in interest rates is going to cause a huge swing in that bond's price.
And here's a really easy rule of thumb to make that real. If you have a bond with a 5-year duration and interest rates suddenly jump up by 1%, you can expect that bond's price to fall by about 5%. It's a super quick way to get a feel for the risk you're taking.
Okay, so that's the risk from the whole market. The second big risk is much more personal. It's all about the specific company or government you loaned your money to. And the question is simple: are they actually going to be able to pay you back?
To understand how this works, we need a starting point, a baseline, and that's a loan to the US government. It's considered the safest loan on planet Earth, so it sets what we call the risk-free rate. Let's just say, for our example, it's 4%.
Now, what if a big, stable company wants to borrow for the same amount of time? Well, the market knows that even a great company is still riskier than the US government. So, to lend the money, it's going to demand a higher rate of return, say 5.2%.
See that difference? That extra 1.2% you're earning? That has a name. It's called the credit spread. And all it is your compensation. It's the extra cash you get paid for taking on the extra risk that this company, unlike the US government, might just run into some trouble. And that leads us to a really important idea. There is a whole universe of different borrowers out there. And as you can probably guess by now, not all of their loans are created equal. This is a pretty handy cheat sheet. A treasury bond? That's the safest loan you can possibly make. A bond from a big, solid company? That's called investment grade. It's kind of like owning a stock, but your potential return is capped. And then you have bonds from riskier companies. We call these high yield, or, junk bonds. These can act a lot like stocks, but without that massive home run potential.
All right, so we've covered the basics, right? Now for the fun part. Let's connect all these dots back to that big promise I made at the start: how bonds secretly rule everything, from the whole economy right down to your personal stock portfolio.
It all starts with something called the yield curve. And don't let the name scare you. It's just a chart. It plots the interest rate for loans of different lengths, from a super short 3-month loan all the way out to 30 years. And it turns out the shape of this curve is one of the most powerful economic crystal balls we have.
See, normally this curve slopes up. You get paid more to lend for a longer time, which makes sense. That signals the economy is expected to grow. But sometimes it does something weird. It inverts. It slopes down. That means the market is so worried about the near future that it's demanding a higher interest rate for a 2-year loan than a 10-year loan. And that right there, that is a classic and scarily accurate recession signal.
Okay, now for the grand finale, the direct link to stocks. There's this concept called the equity risk premium, and it's really simple. Stocks are risky, right? So investors demand an extra return for owning them compared to a super safe government bond. That extra you expect to get, that's the premium.
So, let's play this out. What happens when the yields on those super safe government bonds start to rise? Well, suddenly, that boring safe option is paying you more. That guaranteed risk-free investment starts looking a whole lot more attractive. And if the safe choice is looking better, stocks have to do something to compete for your money. And what can they do? Well, the only way a stock can offer a higher expected return is for its current price to fall. This is the whole mechanism. The bond yield is the anchor. It sets the baseline, and the value of every other risky thing, including every stock, has to adjust itself around that anchor. So that's the secret code. Bonds aren't just some sleepy defensive asset. No way. They are the economic signal. They are the pricing anchor for literally everything else. Which kind of leaves you with one last question, right? The next time you go to check on your stocks, shouldn't you maybe be checking the bonds first?